So let's look at this one. Investing in your 60s plus, you could even say, this is no longer about building wealth. It's about keeping what you've built. There's no room for wild swings, but inflation is still your enemy here. So you can't really ditch stocks altogether. Basically, a sample 60s portfolio is conservative and it's very aware of inflation. Okay. So with this, I'd be looking at 20% in S&P again. So that's SPY or VU. Stocks still fight inflation on appreciation. I would be lowering my NASDAQ exposure in QQQ to 5%. It's a small growth slice, but you're there. If it starts to blow up, you get some exposure. Again, I'd have 10% into gold. So I'd be looking at UGL. It's a hedge and a hard asset all at the same time. Then I'd be looking at TLT. I'd be increasing my stake in TLT, which is the longer term bond ETF. I'd be looking at these income producing bonds. That's what I'd be looking for. I'd have 35% of, cash or cash equivalents or short term bonds, high yield savings account or CDs. I mean, at this age, I'm looking for no risk and no stress, okay? But at this age, your money still has to work for you. You can't just be sitting on the sidelines. People are living longer and longer and longer every decade. So you might have another 30, 40 years to go. So you can't just leave your cash on the sidelines and let it deteriorate from inflation. That's all I'm saying.